Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan. I'm going to be taking us through the Federal Reserve trade plan and preview. I'll explain to you exactly what I'm looking at for this event. If you can see my screen and hear my voice A-OK, please do let me know in the chat box. That would be absolutely great. Hope everybody is well. Just as folks are coming in, don't forget, as we talk about different entries, exits, the whole idea of this is it's an educational perspective. It's not a signal trading service. I'm simply explaining what I'm looking at and the likely reaction of various instruments as we head into the Federal Reserve meeting. Of course, the market can always surprise us. Hope everybody's doing good. Now, the plan for the US interest rate decision. So remember, whenever we're looking at these key events, what we want to see is what's expected, what's the surprise, what's the big picture, and what's the instrument. Now, it's going to be very simple today because I'm only going to be wanting to express the interest rate decision through the gold market. I'll also give an opportunity in terms of what I'm expecting for one currency pair. We'll look at the dollar yen, but as I said, I will explain to you exactly what I'll be looking for here in terms of one currency pair, but my main focus is going to be on gold. So without further ado, let's get stuck in. Now, first of all, let's just look at some data points that we've had. Now, going into this week, very important to notice the inflation data that we've had. And we have had some interesting inflation data out so far this week. And yesterday we had the CPI print, and notice that that came in 4%. That was below the 4.9% prior, and the core was 5.3% below the 5.5% prior. So the first thing to note is both the headline and the core are continuing to show a downwards trend. Now, if you take a look here, you can see, look, the headline dropped again to 4%. Excellent, it's moving in the right direction. The core moving in the right direction. That previous little bump we saw from April, look, it's dropped lower now, down to 5.3%. Clearly, the core trend is lower. So the trend in the core and the trend in the headline, both of which are lower, both of which are reassurances that the Federal Reserve's interest rate hikes are starting to work. Okay, they are taking control of the inflation issue. Excellent. Now, just coincidentally, I happened to be speaking to the Times Radio this morning, Matt Chorley, and I'm just going to send a message starting at 25:10. I talk about some of the inflation problems that there are in the UK. Now, we won't be getting to that today, but at 25:10 on that link I've sent in the chat, you can listen to some of the issues that are happening in the UK with the pound. And maybe we can look at that on Monday, or definitely we'll be looking at that on Wednesday before the Bank of England interest rate meeting. So if you want to start getting ahead for next workshop on Wednesday, check out that link that I speak about there with Matt Chorley in the UK. Now, here's where it gets interesting. We've just had the PPI print out now, and look at this. PPI year on year, falling 1.1% down from the prior of 2.3%. So what does that show us? Again, it shows us that producers are starting to pay less for their goods. Okay, producer price inflation is falling, an excellent indicator. Producer prices, I think that's producer prices. Where do I want? Which one do I want? Core producer prices year on year, okay, continuing to fall. So another drop in producer prices, excellent, below the prior, 1.1% below the prior, month on month, below the prior, excellent, deflationary. Now, as long as that deflationary picture is in place, what that says to markets, this is all about understanding our base case, this says to markets that the US is controlling the inflation picture, and because it's controlling the inflation picture, that's why interest rate markets here, you can see what they're expecting is the Fed to not hike interest rates today. There's currently a 92% chance that the Federal Reserve will not hike interest rates today. Okay, that they will keep interest rates on hold. Now, this is called the Fed pause mandate. There's a hike, pause, or a hold. They're the three options. This is the pause. They're going to pause interest rates, but still kind of indicate that higher interest rates may be still to come. Okay, so that's good news. Now, if you look at the data from a longer period, if you look at the last jobs data, look at the NFP print we had on the Friday, first Friday of June, 339,000, well above market maximum expectations, and participation rate higher, but the unemployment rate was a bit higher, which was a mixed messaging, but very tight labour market still. And remember the Phillips curve? Understand this, that if the unemployment rate is seen high, that's seen as deflationary. Why? Less people in work, less money to go in the economy, less competitive market for jobs, lower wages can be offered, deflationary. The opposite, if it's lots of people in work, that's seen as high competition for employers needing to employ employees. They have to offer higher wages, more money in the system, that's inflationary. So a bit of mixed messaging, but the latest news with this excellent print we've just had here on that PPI, that shows good news. Okay, it just shows that everything's moving in the right direction for the inflation picture. All of that takes the pressure off the Federal Reserve. And now earlier in the week, I was speaking to Bloomberg Ashrak. This was 25% chance they're going to hike by 25 basis points. That's now down to 8%. So markets are happy to say that the Fed's going to pause. Now, let me show you something more. You can see here, Wall Street Journal's Tim Rayos. Now, this chap here is seen as a bit of a Fed whisperer. In other words, if the Fed are going to do something that's going to surprise the markets, the rumors is that Tim Rayos will know first. Now, he has been an unofficial spokesman for the Federal Reserve before. When the Fed came and surprised markets with a larger than expected move, it was Tim Rayos who delivered the message. So if you look at the date here, June the 13th, this was yesterday. What's Tim Rayos said after this inflation data? Well, he said the Fed's expected to hold rates steady on Wednesday. That's what we're expecting. With the May CPI report doing little to change the very near-term outlook, fine. But notice this, officials could use their quarterly projections to signal another rate rise is now the base case, right? And he says officials could pause rate increases this week while penciling in a hike amid unexpected economic resilience. That's that strong jobs data. Okay, so you put that together, right? What do we start to see? Well, when you put that together, we do start to see an interesting picture. And the base case is that the Fed is not going to hike at all. But now look what the focus becomes. You see, they could use their quarterly projections. This is called the so-called dot plot. Only happens 4 times a year, and one of the times it happens is on June. And so what the Fed could do, they could keep interest rates the same, but then they could signal another rate rise is still to come. Now, the last dot plot, the dot plot was 5.125%. So that's what they were expecting interest rates to basically stay at this current level, basically. But if they, in the dot plot, signal another, and the median dot plot goes up to 5.375%, what they're saying is we haven't hiked in June, but we are considering hiking later in July. So watch out for that. That would be an interesting decision. And notice this, you see short-term interest rate markets, they're not pricing in an interest rate move up to that 5.375%. Notice that. They're not. They're not pricing it in at all. Okay? So that's a very, very clear message that's being sent to markets. So if the Fed say, oh, we're going to pause, but then they signal in the dot plot they're going to hike to 5.375%, we could see an adverse reaction. So for today's decision, there's only two tradable outcomes that I see. Okay, the first tradable outcome is if they hike interest rates. Now you can see here, there are expectations that the Fed will potentially hike 5.375% by economists. But we know that interest rate markets only see that as an 8% chance. So in other words, if they do hike by 5.375%, that will be a surprise. And if that surprise takes place, we would expect to see the dollar gain, and I'd expect gold to go significantly lower. Okay, that will be gold lower, and that's my chosen commodity. It will be trading gold. Now, if they hike by 25 basis points, and if they raise the dot plot higher as well, say the median goes above 5.375%, say it goes up to 5.5%, then I'd expect a stronger reaction and more gold downside. Okay, and gold at the moment is just sitting above this lovely support level. That weak PPI print is just pushing gold high. I just took a little long on gold myself, just with that very weak PPI print that we've seen. I knew that would be positive for gold. But if the Federal Reserve later, if they hike by 25 basis points, if they raise guidance to 5.5%, then gold should sell off sharply, and I would expect this recent pattern to break down, and you could potentially look for a breakout retest of that pattern, ultimately looking for a measured move from here down to the 200 exponential moving average would be the target. I'd just make it 1900, that S3 pivot point. So that would be in the scenario with a Fed hike by 25 basis points and via the dot plot communicate that more interest rate hikes have come. That would be negative for gold. That would be a decent tradable opportunity that I'll be looking for. Now, the other alternative is, say the Federal Reserve, say they don't hike at all and they keep interest rates as they are, and say with the dot plot they signal a different picture. Say they signal with a dot plot that we're expecting, interest rates to fall this year. So if they see an interest rate coming this year, and that would be like having a terminal rate of maybe like about 4.875%. Say they signal some falling, that would be very positive for gold. And in that case, you would expect significant gold upside, definitely something to watch very, very carefully. Okay, so watch out for that. That will be the best opportunity. So they're the two opportunities that I see. Okay, so opportunity number one, the Fed hike by 25 basis points, and on top of hiking by 25 basis points, they raise forward guidance, increase the dot plot, expecting higher interest rates than 5.375% or more for the rest of the year. Okay, that would be dollar positive. You expect the dollar yen to rise, you expect gold to fall, equities to fall. That's what you anticipate. The opposite is if the Fed don't hike at all, so that's no interest rate hike, they keep it at 5.25%, or obviously if they cut interest rates, and then if they signal that the dot plot stays the same at the current level, that will still be dovish, but not as dovish as they signal the dot plot to be lower than the current level. Watch out for this possibility. If they don't hike by 25 basis points, but then raise the dot plot to 5.375%, that would likely be hawkish and expect to see gold fall. So don't get caught out. You've got to look at the interest rate decision and the dot plot, and then you also have to look at the press conference afterwards. Okay, so see the event like this. There's the event between 7 and 7:30, and then at 7:30, the market reassesses and see what Powell says at the press conference. So literally what you often get is you'll get, 7 o'clock comes, the market moves one way, and then the press conference comes and the market moves the other way. Now remember, central bankers make it their career to trade these interest rate decision and press conferences, not to trade them, to that's a slip of the tongue. They make it their ambition to manage them. So it's no coincidence that you see the interest rate decision selling the market one way and then the press conference selling the market the other way. The more uncertain, in a sense, market participants are around the release, the less chance you have of seeing, a sudden surge in price to the upside or a sudden surge to the downside that can become impulsive and really disruptive for markets. So from a central banker's point of view, they want to try and keep it calm, and by injecting a bit of uncertainty around the decision, it can help them keep markets a little bit calm. And if a few traders get their fingers burnt, they'll be less likely to come in with high volume, and that can mean less pronounced and less volatile moves. Now that's good news for them, but it's bad news for us as traders because it can be choppy price action. So remember, when we get the decision at 7:30, you got the press conference, and the press conference sometimes will emphasize or sometimes even contradict what's happened with the interest rate decision. So think about it. I've got three things you want to say in your mind. I've got the interest rate decision, I've got the dot plot, and then I've got the press conference. And the best situation is if with all those three line up together. So we want to, the best opportunity would either be will be a dovish decision, and that would be for gold upside would be the best opportunity. That would be no hike or a cut, forward guidance, hopefully potentially lower than 1.25%, and then Powell sort of saying, in line with what we've been seeing, inflation, inflation is falling in the right direction, right? And the more that inflation falls, right, that's the headline falling, that's the core falling. We saw the PPI falling. It's all moving in the right direction. So if we see Powell saying that, then that would be likely negative for the dollar, positive for stocks, positive for gold. That's the one to watch for. So I'm personally only going to be trading gold over the decision, but you can also trade the dollar. So if it's dollar positive, you could look for dollar yen upside because you expect that to move higher in line with the yields. You could also look for dollar yen downside if there's no hike and they signal a cut, etc., etc. You expect the dollar yen to fall because you expect yields to drop lower. You expect dollar yen to move lower in sympathy. So that is what I'm looking for. I hope that feels everyone's ready. As always, market can surprise in its reaction, but that's what I'm expecting. And gold for me is the simplest expression of that at the moment, because it's really a dollar yield and inflation play. That's really what we're looking at. And gold is driven by the dollar yields and inflation. So you can't get a better instrument, in my opinion, that's likely to react in the most predictable way. Thank you, Eamon. Said says, good question, Saeed. Saeed says, what will they, if they say they will pause for now, but they won't cut until next year, and they will project they will keep interest rates at 5.25%. That is pretty much what they've been saying, and that's pretty much as expected. Now, there's something you'll notice straight away, but you'll say, Saeed, hang on, but look at short-term interest rate markets. Short-term interest rate markets are potentially seeing, rates as they are at the moment, and that's what the short-term interest rate markets are saying. They're not expecting any rate cuts this year at the moment from the current level. So that would just be as is, Saeed, and that would be, no trade. I couldn't tell how the market would react to that, right? It would be too tricky. I could see the market doing anything to it, but it wouldn't be a clear. I wouldn't feel my edges anywhere there. So that would be just like, okay, interesting. Let's see what happens. But look, short-term interest rate markets are kind of saying that already. The Fed have been more aggressive anyway, and kind of Tim Rayos has set markets expectations already by saying, officials could use their quarterly projections to signal another rate rise as now the base case, right? So that's kind of what's expected. So that's how I'd say not really tradable. Abu Bakr, good question. Abu Bakr says no hike plus same dots plus data dependency. Is it dovish? I would say yes, right? Because that for me would say that the Fed is saying, oh, we do like the headline moving in the right direction, and we do like the core moving in the right direction. We like both of those. And if they don't hike, and if they keep the dots the same, they're in that wait and see mode, which is very data dependency perspective, and we would be looking at a more dovish approach. I'd expect gold to continue to grind a little bit higher. Would I take a trade? No, I wouldn't, but that's what I'd expect. Horatio says, a very helpful point. Last time that the Wall Street Journal reporter Tim Morris signaled the market the surprise and the hype, the dollar moved prior to the event, taking out a surprise reaction on the price action. True. Yesterday, after his note, yields reversed the move after the CPI moving much higher. Dollar tried reversing, but didn't continue its move higher. So would you say that this time round can also discount a surprise, as the market has been warned already? Therefore, if there was a no hike, but dot plots are raised, the dollar would move higher. But would that be a better opportunity to fade in dollar strength? I see what you're saying, Horatio. That's where it becomes tricky for me. And I agree with your analysis, and I agree that I would expect that reaction, but I wouldn't be confident enough. And because I wouldn't be confident enough, I wouldn't have the conviction to hold the trade. Okay, so Horatio is basically saying, you know, the market's been warned that they're not going to hike, and they've been warned that the dot plots are going to be raised. So you could, you know, it's very difficult to see, you know, what any potential reaction there'll be that is reliable. So that's why I'm focusing on the sort of more extremes, because as Horatio points out very helpfully, look, the market already knows this. So the market, in a sense, is already pricing this in right now. Okay. I think if it does happen, you might see that dollar strength creep back in. But then, as you say, will that be faded? My best guess would be that it would be, Horatio, but I wouldn't have the confidence to fade it. What I would do is I would wait for the next inflation print, and I would use that as an opportunity, with the next inflation print as a potential tradable opportunity. Great work, Horatio, and a great comment. Yeah, so just make sure you're aware of this guy, Tim Rayos. If he's not on your radar, he needs to be, and just follow him on Twitter, and you can just see what tweets he makes. But the market pays enormous attention to Tim Rayos's comments on what the Federal Reserve is doing. And as Horatio says, you know, markets will move on his tweets because he's seen as that voice piece for the Federal Reserve. Okay, folks, next week, big week as well. We've got the Bank of England meeting next week and the Swiss National Bank meeting. So I'm getting us ready for both of those next Wednesday. So if you want to get ready for the BOE, don't forget the link I did in the comments. Check out that Times interview I did. And inflation print's going to be huge, particularly next week. The inflation data you don't want to miss is the inflation data coming out on Wednesday for the UK. It's going to be really, really important. There's going to be such a focus on it. Great potential trade opportunity in the pound. It's coming out Wednesday, 21st June, 7 a.m. I will cover that on Monday, so we're totally ready for that. And then Thursday, we've got the Bank of England meeting. So make sure you come back on Monday and pick up the Monday analysis, and I'll get us ready for that CPI print for the UK. All right, folks, been an absolute pleasure. Thank you all very much. Saeed, Abu Bakr, thank you for your questions. Excellent. I hope that's answered them. Horatio, thank you very much for your helpful comment. And I'm sorry I can't be more helpful on what you're saying. My best guess would be in alignment with what you're saying. But through experience, when I'm a little bit unsure of the market reaction, generally speaking, it's sensible to stay out. Oh yeah, Eamon, I've had the interview. So if you click on that link, Eamon, you can hear me on 25 minutes and 10 seconds. It's in the chat box. If you click on that, I've had the interview. So that can be a little bit of preparation for Monday. Okay, Fahd, yeah, you're very welcome. What's the timeline? It's 25 minutes and 10 seconds. If you hit on that link, and then you'll hear me that. Yeah, that's great. Thanks, everybody. Please do have a very good rest of your week. Thank you very much for attending. Good questions, good input again. So take care and speak soon. Thanks, everyone. Now, goodbye.